Shareholder current account. Do you know what is this and what changes are being made to it? Significant tax changes are being made to it, and the IRD has launched a proposal just a month ago. And these changes will be hugely impacted if you are in business, whether small business, large business, medium business. Shareholder current account, it's going to impact you in some way or the other. So if you want to know what changes are coming to shareholder current account, please be with me in this video. In next 5 to 8 minutes, I'll try to explain you what changes are and what you need to know about shareholder current account. So what is shareholder current account? This is what business owners need to know about that. So what is this? You need to know what credit balance is and what debit balance is to shareholder current account. To simplify and decode it, so debit balance means that shareholder owe money to the company. So you personally owe money back to the company, and credit balance means company owe money to you. So remember one thing: debit, you owe to the company; credit, company owe to you. So what is this? It's a record of all the transactions, whether money coming in, money going out by the shareholders. It's very common in closely held companies, and to be honest, 80 to 90% of New Zealand companies are small companies which are closely held companies. So closely held company means that when there is only 1, 2, 3, 4, like small group of owners, generally families, they are the directors, they are the shareholders, and the transactions happening between them, it's a record, goes to shareholder current account, and that is what it is. And major changes are being coming to it. Currently, how it works in the practice, we need to know what the current practice is, then I will come to next stage, what's being changed. So the current practice is personal funds added as a credit balance, right? And any salary withdrawals are a debit balance. Now, debit balance is treated as company asset and interest charge at prescribed rate. So if you have a debit balance, interest has to be paid on that shareholder current account. To explain this, I'll show you an example in a minute. So interest is taxable income of the company, which is taxed at 28% corporate rate, widely used for tax deferral. This is getting a bit technical, but let me show you an example which will make you understand that very well. Imagine if you have debit balance of $100,000. So what it means is company has paid a tax rate of 28%. The tax has been paid, which is $28,000. This tax is paid by the company, right? Now you got some money waiting, so tax is paid at a lower rate. Now this money is sitting into company's bank account, but company is not physically holding this money. This retained earnings are passed on to the shareholders. So shareholders are getting the advantage of this because their tax rate is 39%, right? So the advantage of this 11% they are gaining. So what IRD says that the current rules are, if you charge interest on this, then it's okay. Then you don't need to worry about it. But what interest does is defer the whole repayment of shareholder current account. And it creates a lot of risk that you need to be aware of. What happens is when the large withdrawals are done through shareholder current account without immediate tax, long-term deferral of personal tax comes to it. And this creates an imbalance between salary and a dividend. So that becomes very difficult when a company goes into problem, any liquidation happens, and so on. This creates a liquidation risk. Imagine shareholder current account is a debit balance. So it's a large debit balance is there. Now, if company gets into a problem, the liquidators ask, the first thing they ask is, where is the money? Can I get the repayment of this? And generally, it's unrecoverable and it creates a lot of headache when it comes to insolvency and things like that. The new proposal, what IRD is proposing, they're talking about this 50,000 threshold So what they are saying, if the values are below $50,000, then you don't need to worry about it. So that's the rule they're trying to propose. Now, why they're making this change? You need to know why this change is being made. According to them, they have published this data as of March 2025, where they're saying 119,000 companies have shareholder loans, right? Some form or the other. That's a large number. Now 50% are below 50,000. So this is how they're coming with this rule, that if the value is below 50,000, then you don't need to worry about it, because 50% of that are below 50,000, and 5,000 are above 1 million, and 500 above 5 million. As you can see, in a large scheme of context, this is why they make to do any changes in that. So why this matters? This was I was trying to explain earlier in an example. So companies are separate legal entity, and 28% is a company tax rate. 39% is top personal tax rate. 11% is a gap between that creates an incentive to defer. So keep declaring as a company's income and keep utilizing the funds. Do not put into shareholder. So how tax deferral works? Profit is retained in the company. You withdraw that as loan, and then you only pay interest, and personal tax is deferred. Let's put that in an example. If company profit is $1 million, company will pay tax of 280,000. Retained earning is 720,000, which is imputation credits attached to its 280,000. So 720,000 is actually retained earning, which the shareholder will utilize. So if they would have done the dividend, they have to declare this, but they have not done it. And personal tax on this is 390,000. So extra tax payable is 110,000. I hope I tried to explain you. This is slightly complex, but the main idea is the deferral is shifting the tax in a later stage. What they are saying, that we want to stop this. We don't want this to happen. Now, they have done some research with international comparisons. So let's look what international comparison is. So in Norway, what they are saying is, within 60 days of the balance date of the company, if this loan is not repaid, that has to be declared as dividend. UK is 9 months, Canada is 12 months, Australia varies between 7 months to 25 years, but they have very complex system with a lot of documentation. Now, my gut feeling is, because New Zealand tax system is very closely aligned with Canadian tax system, so this is why we want going for 12 months. So and once we get to 12 months, what it means is, this is the proposal: any unrepaid loan treated as dividend. 12 months repayment window applies after year end. All right. So if you have, for example, a loan of $500,000 in 2027 and 28 year, this must be repaid by 31st March 2029. If you do not repay this, that to be declared as dividend, which is fully taxable. So this is the new rule. So you get 1 year to repay that. And if you have repaid, for example, you have an overdrawn current account of 100,000 and you have done a repayment of 120,000, credit balance is 20,000. So then you don't need to worry about it, because it's no longer debit, it's a credit balance. Enforcement, December 2025, once it's enacted, that would be the enforcement date. What they are saying, this is all for new, happens after December 2025. Anything prior to December 2025, those balances can remain as it is, and the current treatment can be followed as it is. Now they're discussing possible exemptions. Possible exemptions could be certain employee share scheme plans, and any capital distributions, any specific commercial loans with proper documentation, but more things to watch out, because these things are just a draft and more details will come out in over the period of time. What you need to know about the record keeping. So when you next look at your balance sheet, your financial accounts, do look at it. Shareholder current account is credit or debit? What balance is this? And if it's debit balance, what is the interest rate reporting happening? And then work out a plan that how do you repay that, or you restructure it, do something with it, because changes are coming and you may get caught up into that. Accordingly, IRD will make necessary changes to Tax Administration Act. Plus, implication for businesses, as I said, you need to review your loan balances, you need to plan the repayments, improve the documentation, and monitor your year-end provision. So each year-end, you got to know where you are, what's happening. Practical tips for you, if you're still here watching this video, practical tips for you would be regular account review. So keep looking at your shareholder current account, that what is it, what's happening into it. And as a business owner, you must look at it, what's happening, be on top of it. Second thing, look at repayment strategies. If it's debit, how you can repay. If it's credit, how you can get paid as well. Any dividend plannings to be done earlier than later. So sooner you do, sooner it's better for you for cash flow purposes. Seek professional advice if you're not sure about something. Conclusion, this is a major shift in the treatment in the history of since I have been in accounting and we've been operating shareholder current account into balance sheets and things like that. It's a major shift that's happening, that if it's not repaid within a year, that will be declared as a dividend. So which is a major shift that's happening. High balance is a greater focus. 50,000 and below would be left as a risk, and early repayment is essential. Thank you for watching this video. If you want more videos like this, please subscribe to our channel and support us. Thank you very much.